Welcome to Galaxy Brains.
An infinite amount of cash.
I'm your host, Alex Thorn.
The U.S. banking system is sound and resilient.
Bitcoin made a new all-time high.
If you're not long, you're short.
Satoshi's going to come on there, laugh hysterically, go quiet, all Bitcoin's going to be erased.
Bitcoin's the best crypto out there.
Bitcoin is going to zero.
Welcome back to Galaxy Brains. As always, I'm your host, Alex Thorn, head of firm-wide research at Galaxy. Bitcoin not zero. We have a great episode for you this week. Greg Xethalis, partner and general counsel at Multicoin Capital, joins us to talk about regulation, the current state of the Clarity Act, and whether or not it is important for crypto that it happens this year, the state of negotiations, and much more. And of course, we'll talk with our good friend Beimnet Abebe from Galaxy Trading. As always, the 200-week moving average on Bitcoin basically hit last week. We'll ask Beimnet if that updates his thesis going forward. Before we get to that, I need to remind you to please refer to the link to the disclaimer in the podcast notes, and note that none of the information in this podcast constitutes investment advice or recommendation, offer, or solicitation by Galaxy or any of its affiliates to buy or sell any securities. We got a great one here with Greg, so let's hop right into it with Beimnet. Let's go now to our friend Beimnet Abebe from Galaxy Trading. As always, Beimnet, welcome to Galaxy Brains.
Thanks for having me.
Well, I've got to give you your flowers maybe one final time for the near term, because I think people are getting sick of you winning so hard on Bitcoin price. We on last Thursday was February 5th, one of the biggest single day drawdowns in Bitcoin price history. Dropped Monday through the low point on Thursday from like 84 to 60, a massive drop, a 25% decrease. But just on Thursday, February 5th, Bitcoin was down 15+%. And 60 basically is that 200-week moving average that you've been citing. I think technically it's around like the low 59s or 58, high 58s. But I mean, for all intents and purposes, it basically got to your target. Yep. So where do you stand now on your thesis? It seems like it played out. It may not be done playing out, but it got there. Like, how do you assess from here for Bitcoin?
Yeah, I mean, I think the best way to, think about Bitcoin is just kind of on a historical analog, right? And one of the better charts that I saw this week was just kind of, days after Bitcoin's peaked and, the performance in the last, Bitcoin cycles. And essentially we're following the, 2022 kind of bear market cycle pretty closely. I think we're around like 125 days since we peaked, and, we're down somewhere in the ballpark of 43-44%, and the last Bitcoin correction 125 days in, you were down like 43. And so I do think that the historical analogs are super relevant. And historically you've seen a high to low move of 70% ish, maybe a little bit more on average, in terms of full blown corrections in the market. And so I do think that, that's in the cards. I do think that's going to be a little bit later. Even myself with the, 200-week moving average, I was definitely a little surprised by the pace of the move. Not surprised by where we got to. It's just that, the pace of the move was kind of, unexpected, even for folks that were very bearish. And so, right here, right now, I think the most likely path is probably consolidation before resumption of the trend lower. I do think that until the 200-week moving average gives away a support, that it should hold on the next test of that level on a weekly close basis. But I do think that there's probably a little bit more pain ahead. And, the analogy I like to kind of go back to, besides the historical analogy, is kind of, what happened after October 10th, right? You had this huge move with, billions liquidated, and, you had a pretty sharp rebound thereafter. But, as the weeks progressed afterwards, we realized, there was a lot of damage done by that. And, there are a lot of dead bodies, to put it bluntly. And that led to significantly weaker liquidity conditions, some more aggressive forced selling into thin liquidity, etc. And so given how quickly we've come, I do think that there is some collateral damage in the market that will just take time to present itself. And so right here, right now, I think in terms of areas that are good kind of value areas, in the near term, I think any dip to the 200-week moving average probably gets bought. And I think the only reason that we truly have to break that level is probably a broader correction in risk markets and U.S. equities in particular. I think that probably kind of is the next catalyst for a move lower in Bitcoin through supports. And so, and again, you might not get that equity correction, but I do think that there is a lot of tension and angst in the market. And, that's for a whole number of reasons, but, AI is definitely kind of at the forefront of that.
Well,
and
before
so
before we get deep into that, and I want to talk
trend.
about that. Yeah, you're still eyeing that 200 week as a good value zone. You're saying could go lower. I don't think you're saying the other prior bear market drawdowns were the last one was 70%. That would take us down to 37.5. That seems extreme, does it not?
Yeah, I think that is extreme. I just I don't think we can get there because there's been a lot of Bitcoin that's been purchased that is not ever going to be sold. And so I do think that the floor is a little bit higher than past cycles. But again, I think you have to kind of respect history. But ultimately, what we've done in past cycles around the 200 week is you kind of dipped a little bit below and consolidated, before resuming your trend higher. And I do think that's probably what's going to happen. It's just it takes time for markets to heal. And I think we're probably call it 6 months, 6 months plus away from the market truly having healed and feeling like we can easily kind of go back higher. And so I'm optimistic for BTC kind of in Q4 of this year and possibly in Q1. And to be honest with you, I think a lot of folks struggle to find a narrative that supports crypto at the moment, but ultimately I do think that narrative is something that follows price action and not the other way around, particularly in such an esoteric kind of asset class. And so I really do think that once you start getting a healthy rebound in crypto, that the narrative will naturally follow. And to be honest, the hard asset Bitcoin gold narrative has not gone away. It is not like the debt has gotten any better. In fact, we're still printing historically high levels of deficit spending relative to GDP. There's still kind of a big self-custody component of crypto that makes sense in the world of today. And so I don't think any of the things that we've talked about historically for crypto and the value proposition has really changed. And same thing, you had this crazy correction in silver and gold. But at the end of the day, central banks are still buying gold pretty aggressively. A lot of folks are keen on diversifying away from U.S. assets, and gold's been around for centuries, and it will continue to preserve purchasing power. And so there's a lot of short-term noise, but taking a step back, fundamentally there hasn't been too many things that have changed. In fact, I would argue that the moment that the narrative comes back in crypto, the financial access is there such that you can easily actually kind of surpass the highs you've had in prior cycles or the 120K. And so I think it's just a matter of time, but it might be 6 months to a year.
Yeah, and maybe a little more pain before that happens. Okay, that's great. Let's get back to what you were saying about equities. A lot of angst. Yeah. I saw conversation, I guess you always climb this wall of worry, but in the fall and in the early winter, it was a lot of angst around whether the big hyperscalers and tech companies can keep this level of CapEx spending on data centers up. Now it seems like people are really starting to worry about straight up job losses from AI productivity. What is in there? I saw we talked about this. Big tech name was down a lot on concerns that their major productivity suite of SaaS software was going to be displaced by AI. I saw this morning on CNBC discussion about wealth managers being displaced by AI. Is that at the core of the sort of the current wall of worry?
Yeah, I 100%. There's a lot of companies that are directly at being threatened by AI, and the way I've seen it best phrased is kind of one from one of these banks, but essentially for these hyperscalers to get a reasonable return on invested capital, they have to essentially take market share away from existing companies, right? Like if you're doing your tax and accounting on ChatGPT or Claude, right, your H&R Block is not going to get that business, right? And so it's a little bit of a zero sum game because everyone needs to file services, file their taxes, for example, but like it's just a question of like who is going to be doing that filing. And you could argue that prices in general will go up, and so maybe these guys get more wallet share, but then it's coming from the consumer. And so there is like a zero sum element to this. And a lot of folks think that having the dominant AI is kind of a winner take all market. And so even amongst the hyperscalers themselves, like there are going to be winners and losers, and these guys are betting hundreds of billions of dollars in this AI arms race. And so I think as this trend continues, like, yes, the labor market and the commoditization of software engineering skills, like that is going to be super relevant for the labor market. And right now it's being felt by recent college graduates, but in a couple of months there'll be more senior software developers, et cetera.
The pace of AI development, it frankly, if anything, seems to be accelerating. But even if it continues on the linear path, it would still portend drastic. If you look at these new models, they're so much better than just 6 months ago.
Well, it's and to your point, I mean, these models are now like recursively learning from themselves and like improving on their own at a faster pace.
Yeah,
right.
Anthropic said, I saw in their latest model, which came out last week, they disclosed in part of it and in their docs that they had used Claude to help build this version of Claude. It starts to feel like a snowball gaining steam here, or gaining size.
Yeah, and then and that's just on the software side of things. Like then there's like the actual like robotics element as well, right? So you combine robotics with AI, and this is kind of like what Elon's been preaching recently, and the implications are just insane. Right, you've got AI learning at a faster rate, and robotics like advancing at a faster rate, and robots can build robots, right? And so it just becomes like this kind of like insane web that's just expanding faster and faster. And the implications for society, the labor market, broader financial markets, is very challenging for people to predict. And so I think there's a lot of parts of the market that are trading out of fear and lack of understanding and just uncertainty. You wouldn't know that by looking at the outright level of like the S&P 500 or the Dow Jones or the NASDAQ, but the carnage that's happened underneath the surface is immense. And I think it's quite telling of just like how uncertain and fearful market participants are.
Yeah. All right. Well, we'll stay watching it. I personally think if we get that AGI, they're going to want Bitcoin for their savings, if not stables for their.
I think that's totally possible.
Yeah.
And I mean, there's just so many areas that like I truly just don't know.
Yeah, I
Like,
know. I know. And
am I going to get replaced? Or are we going to just have trading agents that,
you can just clone us on this podcast as well. I mean, we've got so much source material to learn from.
Exactly.
All right, we'll leave it there today. Beimnet Abebe from Galaxy Trading. Thank you so much.
Thanks for having me.
Let's go now to our guest, Greg Xethalis, General Counsel and Partner at Multicoin Capital. Greg, thank you so much for coming on Galaxy Brains.
Alex, it's awesome to finally be on the show. Long-time listener, first-time caller.
I'm a big fan of you too, Greg. And before we start, although our guest this week is a partner of a registered investment advisor, nothing in this podcast should be considered an offer of Multicoin's investment advisory services or should otherwise be confused for investment, tax, legal, or other financial advice. Disclaimers out of the way, Greg. Let's jump right into it. You work a lot on crypto policy for Multicoin, but there's not that many. It's not really that big of a group of people in the industry that are deeply involved in the formulation of and advocacy for crypto policy. What would you say just on the Clarity Act, which is the crypto policy legislative item that's at the topmost of the agenda now? What is the state of the Clarity Act negotiations in your mind today?
Yeah, it's been a big focus for me and a lot of folks in the industry, both last year when we were focused on the House side and this year when we move over to the Senate. And the bills are different in some respects. I think they've gotten a little bit closer together in the most recent iterations. But I think first structurally, there's a big difference between a bill moving forward in the House and a bill moving forward in the Senate. And that helps define some of the differences in approach and why it seemingly might have been easier to get through the House. And we had Fit 21 pass 2 years ago in the House, and then Clarity passing last year, both under French Hill's leadership and stewardship. I think the first principal difference is in the Senate, you've got to get to 60 votes to move anything. So when you've got to get to 60 votes, the dynamics of negotiations change entirely. Ironically, I think in many ways that makes it easier for a bill to become bipartisan in the House because you have less whipping around going from 52, 53 votes to 60 when people are incented to, or it's easier to get a bill on the floor. Another big difference between the House and the Senate is in the House, everything could be built in one bill. So when Clarity was going through the House, it was one document marked up in two separate committees, the House Financial Services Committee and the House Agriculture Committee. And in the Senate, it's actually got to be done as two separate bills that are then merged together on the floor. So we've seen the Senate Banking Committee led by Tim Scott and Cynthia Lummis as the Digital Assets Sub-Chair, guiding the banking portion of the bill, which touches on taxonomy, things like resale restrictions, disclosures, stuff that is more cited in the SEC or the banking regulator framework, including things like, certain portions that might touch on money transmission, money services businesses, stable coins, et cetera, et cetera. And then in the agriculture side, we have, things that are assigning spot authority to the CFTC and assigning authority to the CFTC and presumably the National Futures Association as their self-regulatory organization to actually regulate intermediaries. So the ag version of the bill is, has intermediary in the name because that portion of the bill is regulating the trading platforms, the custodians, the brokers, the dealers, and giving authority to the CFTC over spot markets for the first time. And we actually have seen the ag portion of the bill go through a markup. So the ag portion is clear to get to the floor now. That markup was, I believe, a week and a half, 2 weeks ago, passed on a partisan basis. However, there was a lot of bipartisan feedback and agreement that portion of that legislation will continue to evolve as it works towards the floor. And I think it was what I would refer to as a very cordial partisan markup. And in the banking side, they've really been working for, really since before the government shutdown is when the work picked up. And they've been working very hard on trying to get a bipartisan bill through committee. and getting buy-in from particularly a group of 12 Democrats who have been really working hard on trying to refine the bill with the Senate banking staff and other interested members on the R side. That part of the bill is still actively being worked on right now. And I think there are, Alex, I may be jumping ahead of your next question, but the four sort of core areas of discussion around the banking side of the bill, which are being worked on by all hands right now, are one, this stablecoin yield issue, where the banks have interposed themselves. The second is Title V, which addresses tokenization and the regulation of tokenization by the SEC and CFTC. And the third segment is around DeFi, which is Title III, and some of the illicit finance controls and rulemakings that are being mandated by the bill. And then the fourth is still some cleanup and touch-up items in token taxonomy, including some of the disclosure burdens that are imposed on digital asset originators.
So I appreciate that overview of the sort of those core, what I talk about as sort of the tip of the spear negotiating points. It feels like stablecoin rewards, though, is sort of like the main hurdle. Is that, and that perhaps those other items, there's a line of sight to a compromise that all sides could accept. Is that a fair way of thinking about it?
I think that's correct. That I think there is a line of sight towards a compromise and a bill moving forward on all of these items. I think one of the distinguishing aspects of the stablecoin yield issue is the parties that are coming at opposite ends are different from everywhere else in the bill. So, the issue around stablecoin yield is in the Genius Act, an issuer is not allowed to pay rewards to the holder of a stablecoin. It's a payment instrument. It's not a deposit account. It is not like other interest-bearing investments. It's a payment instrument. Now, that payment instrument will hold, the issuer of the payment instrument will hold typically U.S. Treasuries or other relatively safe assets as strictly governed by Genius. And it will earn rewards on that. It'll earn income on that reserve. And what we've seen emerge, notwithstanding the prohibition on yield-bearing stablecoins, is that a company earns rewards, it's going to use those earnings for marketing and distribution arrangements. And those can be very diverse in their structure. What the banks are particularly concerned about is some of those distribution agreements look to them like yield-bearing stablecoins, just indirectly. I have some criticisms of their analysis of this. I think it's a little myopic, and they're not necessarily, they need to broaden their aperture to understand the entire environment. I mean, Alex, when I think I first opened a SunTrust checking account in Nashville when I got to Vanderbilt, I think I got a toaster when I got that, and that's a reward for holders. Now, obviously, that toaster didn't come in the form of 3 or 4% rewards for holding a balance, but this is not something new that parties in business will deploy capital as a customer acquisition cost. And from the point of view of a stablecoin issuer, they are paying distribution to partners in a number of different, structures to help broaden the use of stablecoins. It is not simply, hey, I'm going to give you money. Can you go pay it to someone who holds my token holders? That's not the way this works. And I think we need to assess the issue of stablecoin yields more from the idea of, are we going to make it impossible for stablecoin issuers and their partners? Are we going to hamstring them from business development work? Because that's functionally what this is. And I did attend the first of 2 crypto industry and bank meetings last week at the White House. So got to participate and see a lot of the discussion there. And I do think progress is being made there. But the unique part of it that I was getting towards is in this particular issue, the discussion is not between crypto and Republicans and Democrats. The issue is not Senate banking and Democrats discussing. The issue is not traditional financial services and any of those parties discussing. It's specifically, the banks and the crypto industry participants who are interested getting into a room and trying to come up with a compromise on what works for both industries, and then having it subsequently vetted by banking staff and the Democrat leadership in the Senate. And eventually, by the way, this will have to go back to the House and be looked at as the two bills, the Senate version and the House version, get consolidated into one bill that hopefully goes to the president's desk at the start of this spring.
It seems like there's such a diverse range of stakeholders in this debate, whereas during Genius, which was also quite a complicated legislative package to advance, it was a bit more narrow in terms of who cared about it, and the banks didn't seem to be nearly as active and activated in advocating during the Genius Act negotiations last year. Is this too complicated to get done in this Congress, or do you think it's still got a good chance?
Well, I think so. The banks were at the table in Genius, and Genius regulated stablecoin issuers. I think the distinction is now market structure is regulating additional intermediaries, exchanges, brokers, dealers, other platforms. So where the banks have come to the table with a very hard line on this is they want the prohibitions on yield from Genius to be extended to marketing arrangements with these newly regulated intermediaries. So again, the ag side brings digital asset platforms, custodians, brokers, dealers, et cetera, all into line here. And the banks are looking to expand the restrictions to broader market participants.
I think that's a fair distinction, by the way. I think a lot of people feel like the banks are trying to retrade on Genius, but your point is Genius didn't impose new regulations on intermediaries. This is the bill that would do that. And so here they are again saying, well, if you're going to, have intermediary regulation, it should extend. But it does feel like the banks are the ones asking for something beyond what exists in current settled law. And so they're kind of the ones that need a restriction to be added. Whereas, Coinbase is paying rewards on USDC today, right? So shouldn't they be the ones to blink here? It feels like they're digging their heels in, though.
Yeah, and I'll say, the more generous interpretation for the banks is this is not a retrade because now we have regulation of the intermediaries. I think a more practical interpretation of their actual asks is they are looking for a retrade. They, out of the meeting yesterday that took place on a Tuesday of this week, we did see the banks put forward a document of asks, and those asks are dramatically more than anything that appears in the current version, the ANS of the Senate banking draft. And it does look like a retrade. Now that's a starting position, and obviously you don't start from what you want to accept. But it's a pretty aggressive. It's pretty aggressive. And again, having been in the room and heard what I heard last week, and having been involved in discussions, I do think they're looking at this from a very Sith-like absolutist perspective. That being able to deploy reserve earnings in any way should be prohibited under the guise that this somehow will crush community banks and the deposit flight. And there's quite a bit of, I'll be generous again and say exaggerated discussion of the risk there. And we saw this, when money market funds were first introduced and presented a challenge to business accounts and saying this is a disaster for the banking system. This will cause deposit flight. There's an oft-cited number that's attributed to Treasury when in fact it was a bank bank report to Treasury saying that there's $6.6 billion of capital at risk from stablecoins for deposit flight out of banks, particularly community banks. That's like saying Bad Bunny did a Super Bowl concert in Spanish, and therefore there were at risk of 330 million Americans moving from English as a first language to Spanish as a first language.
Six billion or 6 trillion?
They say $6.6 trillion of capital at risk. And to be clear, that is all of the capital in deposits.
Yeah.
That is not actually what is at risk of departing, nor do stablecoins reasonably present a material risk to that. There are a lot of factors at play that impact deposit flight. Most notably, we perhaps need to revisit FDIC limits, because FDIC limits certainly give the perception of greater exposure for people at community, small, regional, mid-sized banks versus someone who's parking their capital at a GSIB or bulge bracket bank, which is too big to fail. So if we're really looking and concerned about deposit flight, particularly at these small community banks, we need to be looking at what are the risks for bank failure. And I think people colloquially think of banks as this hugely stable thing. My money's parked in a bank. No, it's rehypothecated. And banks actually fail all the time. It doesn't just take a banking crisis. We had a bank fail last week. I'm blanking on the name of it.
The one in Chicago, a Metropolitan or something. I forget the name. Yeah,
that's correct. Like, this does happen. And the FDIC Act, established a system to provide greater security, but those limits are $250,000 for a customer account. And looking at different ways where we can, both improve the business opportunities for smaller regional, mid-size, and community banks, improving technological opportunities. And there's actually a lot of things in Genius that are very interesting for tech-forward smaller banks to be able to leverage this technology to use these open neutral networks as a way to get an edge or come closer to a playing field with some of the larger banks by improving the payment systems writ large. I mean, we've seen, Erebor launch as a new bank this week. They got their charter on Friday. And they are a bank that is leaning steadily into the narrative of new payment rails. They're going to be stablecoin supportive on day one and are building from a tech-first basis. Now, Erebor is not going to be a small bank for very long. I think it's going to grow pretty quickly. But there are opportunities to leverage this technology that come both from Genius and also from market structure itself in improving the payment rails globally and within the nation. I go back, 2015, the FedNow initiated the FedNow effort to modernize the American payment system, and crypto is a part of that. Stablecoins are a part of that, and when we look at deposit flight, when we look at the challenges of our distributed banking system in the United States, there have been a lot of pressures, both from the government as well as from the market uncertainty sort of overall, that have been pushing towards more bank centralization. That's not a good thing. We want smaller banks to be able to succeed. We want bank credit to be out there on the street. We don't want deposit flight, but this is creating a boogeyman out of stablecoins, which is not the issue at hand. Stablecoins are not a material threat for deposit flight, particularly when looked at and ranked relative to some of the other risks. And there are efforts that are out there. Senator Haggerty has a bill to reassess FDIC limits. French Hill has been a champion of community banks for a very long time. And there are things that can be done to improve the situation for smaller banks that don't simply rely on tamping out a technology in an industry that when you draw back and expand your time horizon could actually do a lot to help these smaller institutions.
That makes a lot of sense. What about, just before we move on from clarity, a couple of the other issues you mentioned? You talked about Title III, which is sort of where all the DeFi related stuff is. I know this bill has some enhanced clarifications on front-end DeFi website compliance. I know with OFAC sanctions. Actually, my understanding is that's not enhanced. I mean, all American legal persons are required to comply with OFAC sanctions, whether or not you're a website or a person. But there's other stuff in there about a non-decentralized financial ledger, which seemed to set some thresholds on what type of, even possibly an L2 might have to perform, might be an intermediary and not a decentralized ledger. Where do those issues stand? And do you think if we get through some compromise between the stablecoin wing of the crypto party and the banks on rewards, will these present problems, or has the industry and have lawmakers reached what seems like a viable compromise on the DeFi issues?
I think there's a path there. Language isn't set yet. In addition to my role at Multicoin, I'm also on the board of DeFi Education Foundation, which is one of the two entities associated with the DeFi Education Fund. And Amanda Tuminelli and the team at DEF have been doing a remarkable job sort of assembling feedback and from the entire industry, both the larger stakeholders like venture funds or exchanges or what have you, but also the cadre or cohort of the industry that they represent, DeFi protocols. And they've been working very hard. Amanda's been doing yeoman's work on working on solutions with banking and the Democrats. And I think one of the issues that it is really hard to get legislation or regulation on DeFi right. It's really hard because where these things are truly neutral networks and truly decentralized, like Paul Atkins said this in his Project Crypto speech in July of last year. To paraphrase, we shouldn't speak into existence intermediaries. Just because 90 years of financial regulation in the United States has relied upon highly regulated and deputized intermediaries to fulfill the objectives and policy goals of the government doesn't mean that non-intermediated systems can't exist and be legal. The first guidance in crypto on crypto from any government entity in the world was the 2013 guidance from FinCEN. And it made clear that the absence of an intermediary is not disqualifying. If you are a user, you're not a regulated entity. If you're an exchanger, you're a regulated entity. And if you're an administrator, you're a regulated entity. So to your point of the non-decentralized systems, I think one thing this bill does, which hasn't been there previously, is it tries to say not only what are the rules for DeFi or what are the obligations of participants in a DeFi ecosystem, but it also seeks to say, okay, what isn't a DeFi system? Because that is the biggest challenge the industry has. Is I genuinely believe that a lot of people say none of this is really decentralized, and in many cases they're not wrong. Like Celsius was out there saying that they're a DeFi protocol. No, they were a centralized lending company. So just calling yourself DeFi doesn't get you out of the scope of doesn't give you some regulatory advantage. If you actually are decentralized, that's a different story. Now, what we need to hold space for is things like security councils and some sort of sandbox environment where a protocol, when it first launches, has some controls in, because those types of circumstances, whether it's a multi-signature that is governed by a decentralized governance entity, a DAO or something along those lines, or a security council that is deputized with certain limited authorities to stop cybersecurity incidents or to patch a newly identified threat, those things are policy goods. We should not be taking that away just because it might impact the definition of administration. So that's a very important, I think, good faith step forward. I think some of the concerns on Title III are a lot of the issues are punted to rulemaking, particularly from Treasury. And while you might have some more confidence in rulemaking that might be done now, no one wants a scenario where rulemaking can be weaponized in the industry in a way that would kill it, because we have seen people who have sought to do that as recently as Check's watch 14 months ago.
Yeah. And on that point, Greg, just to wrap up clarity, how important is it for crypto that we get something to pass? Because it seems like we're going to get most of what we want in the absence of any new legislation from, administrative guidance or administrative relief, interpretive guidance from the existing regulators, at least during this administration. Is the primary issue here that 3 years is good, but codifying in statute for 100 years is better, right? It's more to prevent against a rollback in the case of another administration that's hostile to crypto?
Yeah. So the best defense against future hostility from the next Gary Gensler is build products that are good for people, that people want and that people use. It's much harder to kill an industry that has traction among real consumers. And we've seen that in some instances where things are being adopted. And stablecoins is a good example of that. Another good example is even something as simple as like Helium, where there are 2.5 million daily active users of the Helium network. Most of them probably don't even know they're using it. But this is the way you create a foothold. You show policymakers this is a real good that users want. So that's the first most important defense. Whether or not we need clarity, I think the SEC has a lot of flexibility to create good rules. And those rules aren't necessarily going to be everything the industry wants, meaning it's not going to be no rules of the road. Paul Atkins is an incredibly principled individual, and he's driving to create real rules of the road that protect investors, protect consumers, but allow innovation. That's what he's trying to do. It's not no holds barred. It's not an industry giveaway. He's putting substantial rules and imposing duties and obligations on market participants. And most market participants are welcoming that. We want clarity. We want regulatory certainty. And more importantly than anything else, we don't want bad things to happen to good people. Where it's a little tougher is Mike Seelig, who took over at the CFTC at the end of the year. He's got a little bit less flexibility. He needs the ag half of the bill to get authority over spot markets. And that authority over spot markets is really important for the industry as a whole. We don't want a hodgepodge of 55 different states and territories creating money services regulations that are imposed on, again, trading platforms, custodians, brokers, dealers. You want that to be pulled up to the federal level, not only because you don't have to file with 55 or 54 jurisdictions, because Montana doesn't really regulate money transmitters, only cattle and good skiing as well, big skies and whatnot. But you don't want 54 different sets of rules, but you also want a well-resourced regulator that can understand this industry, because it is different than that which came before. And even in New York, which has done probably the best job of any state at DFS, it's tough for them to stay resourced. And when people learn enough about the industry, they're not typically staying that long at DFS. So it's a good for consumers. It's good for just about everyone to bring that regulation up to the federal level and cite it at the CFTC. But Mike can't do that on his own. He needs some legislative authority. There are other things he can do around the derivatives markets in crypto and other crypto adjacent areas like prediction markets, where he can get a lot done there. But if we really want a good comprehensive set of rules that improve market quality, market structure, and consumer and investor protection, legislation that can lead to rulemaking at both agencies, including a lot of joint rulemaking. And one of the priorities for Paul Atkins and Mike Seelig is harmonizing some of these rules for crossover areas where people are dual registrants. That's been a big focus. And Mike announced that Project Crypto at the CFTC was merging with Project Crypto at the SEC. We're really excited by that. I think that if we don't get legislation, it's a little bit harder for the CFTC to accomplish everything that they want. For the SEC, I think they have a much more clear path to execute and have a lot of stuff ready to go to get done on that end.
All right, this was great, Greg. Let's shift gears a little bit and talk about Multicoin. I saw that Kyle Samani, co-founder of Multicoin and original probably general partner, I'm assuming, is leaving Multicoin Give us an update on. I know that I saw that Multicoin put out some updated theses on their investing. Your partner and your general counsel there. What does the future look like at Multicoin? Is it different, or give us the overview on this rejuvenated thesis that Multicoin has put out?
Yeah, so Kyle stepped away at the end of the month and has shifted into an advisory role. Kyle's still around. He's still going to be tweeting a lot about Solana and supporting our portfolio founders from a lot of different different verticals within our investment portfolio. It's a big change in that Kyle has been the face of the firm. But what people see externally is very different from what folks see internally. And there is a tremendously strong team and bench at Multicoin. Over the course of the last couple of years, a lot of our venture work and thesis formation has shifted from, Kyle and Tushar, who's the other co-founder and managing partner. On the venture side, a lot of that responsibility has shifted already to Spencer Applebaum and Shayan Sengupta, and the other members of our investment team, including Matt Shapiro and Vishal Kankani and Eli Kwan. So that's been in the works for a while. And most of our recent deals for the last couple of years have really been led by Spencer and Shayan. And then Tushar, not as public facing as Kyle, still pretty public facing, but he's been the core managing partner who's sort of managed the liquid side of our portfolio for really since inception, and has also been really key in thesis formation in a variety of areas that touched on sort of market structure, also been one of the leading architects of the DePIN ecosystem from his seat at Multicoin. So it's been, a very smooth transition so far, gotten a lot of positive feedback from our LPs, the portfolio community. It's been really nice to see the amount of love that Kyle got on Twitter, which is probably a bit of a new experience for him because he's a little controversial on Twitter. But, I think people have a lot of respect for the ideological imprint that Kyle has had on broader thesis formation, particularly around the idea of modular and integrated chains and some of the structural issues. His departure was somewhat paired with Vitalik's L2 discussion, which is something that Kyle had spoken a lot about. So I think it's Kyle should feel really proud about his time at Multicoin, his work building up a team that's been here for really, really long. I think the average tenure of folks at Multicoin is a little over 5.5 years. And for an industry that hasn't really been around for much longer than 5.5 years from a venture perspective, Kyle and Tushar built an institutional firm, and now it's Multicoin 2.0, and we released our first new true iteration of our investment theses since 2019. Tushar, Spencer, and Shayan worked really hard on that, as well as the rest of the team, and it highlighted minor shift of focuses. A lot of those foci really relate to what it's always been at Multicoin, but we touched on about 8 themes in that paper, and that paper is, and maybe you can drop a link in the show notes, but you can also find it at multicoin.capital. It's a 30-page report, really some interesting stuff. And it really talked about 8 core areas. FinTech 4.0 is first. That's, stablecoin enabled financial services. How do we move from, traditional banking and payments infrastructure to what FinTech's brought, and now the types of programmable rails that stablecoins can do to give more control to their users and more programmability. We talked about the DeFi mullet. My hair doesn't grow enough to get a good proper DeFi mullet myself, but it's thinking about, front ends, middleware, and back ends of DeFi and how that'll integrate into broader finance. It's also financial globalization, broadening access and deepening liquidity within a global lens. The new forms of credit, and as a lawyer, I always am reticent to say credit with respect to crypto borrow lend because it's not true credit in most instances outside of a handful of areas like Maple. But more efficient borrow lend that can come from protocols like Aave and Camino. We've also talked a lot about entertainment finance, which are things like predictions and betting markets, which leans sometimes a little into the financial nihilism era. We talked about programmable ownership, which is coordinating people's jobs, capital. Credibly neutral blockchains is also an area of tremendous importance, both from the policy side as well as the investing side. We think that credibly neutral blockchains are where most of this activity will be cited. And then also cryptographic primitives, some deep tech, whether it's things like FHE or quantum and things of that nature. And I think if you're looking for a change in or shift in the theses versus what we've talked about in 2019, I think part of it was that we're looking at Web3 in most instances as more a longer term narrative. And there's been some discussion about this. The rails have to get there first, and the adoption of the rails have to get there first before we can see some of the Web3 economy taking off in the near term. Now, there are areas where the Web3 economy has been successful, and we've seen some tremendous work in the DePIN area. I know DePIN is not the hottest sector right now from a price action perspective, but from an adoption perspective, it's really picking up, whether it's things like Helium or Geode or a lot of the compute market type of stuff. So we see some activity there for idiosyncratic nature of infrastructure, but the consumer Web3, we think, is trailing a little bit more and view that more as a longer term thesis rather than a short to medium term thesis. But the conviction is still very high in those core theses. And as the venture market has been somewhat distracted by some of the later stage and public equity type of work recently, the builders aren't. And we're still seeing interesting things come online and, are very excited by what this current marketplace is going to bring as new founders come to market.
All right, and Greg, I'd be remiss if I didn't end this conversation with some discussion about the Vanderbilt Mafia. Our audience probably doesn't know. Both of us went to Vanderbilt. And I want to ask you about, there's a surprising number of people, particularly in financial services policy and legislative, in Congress, that went to Vanderbilt as well. This is not private information, but it is nonetheless not widely known. Who give us a flavor of who else is a Vanderbilt alumni that's in this, especially in the sort of the crypto financial policy complex?
Yeah, so you've got kind of two generations, and the crypto native ones are in the later generation, not surprisingly, but this really started in the late 70s. In the late 70s, on campus undergrad, you had at the same time John Rose, who's a congressman on financial services and has been pretty friendly on crypto stuff. But you also had French Hill and Bill Hagerty as undergrads and good friends on campus in the late 70s. French Hill, obviously chair of House Financial Services, the architect of clarity in the House. Bill Hagerty on the Senate Banking Committee, who was the architect of Genius and the principal proponent there, alongside Cynthia Lummis and Kirsten Gillibrand and Tim Scott. And I'm forgetting someone. There was a fourth, may have been also Brooks. And then Bill Hagerty moved over from the undergrad campus, took a few steps over to the law school, where his classmates, his roommate was a guy named Paul Atkins. Their classmate was a guy named Christian Carlo, Crypto Dad, former chair of the CFTC. Also, Governor Abbott of Texas was there at the same time, but we've got to get him a little more engaged on the crypto side down in Texas, where they've had great boon and help from Bitcoin miners with ERCOT. But you fast forward about 20 years or so, or 15 years, and my freshman hall had myself, Bart Smith, who ran crypto for Susquehanna for a number of years, and now is president of a digital asset treasury company focused on Avalanche. Trey Shelton, who's a headhunter in the space at Position Co. And then a little after that, my fellow Blockchain Association board member, Bill Hughes, who runs policy at Consensus, was on campus with me at the same time. Around the same time, Colin Lloyd, a partner at Sullivan Cromwell, who's one of the preeminent attorneys representing large crypto institutions. You came along around that same time in your seat at Galaxy. The head of policy at the Blockchain Association, Lindsay Frazier, would have started probably a little after you. So we've got a nice run of really policy focused Vanderbilt Commodores. And actually, as luck has it, when I was down in DC for the yield meeting last week, I got to run into Chancellor Diermeyer, who's the outstanding leader of Vanderbilt, and got to thank him for the fine work he's done for the school, and especially for his support of the amazing athletics department, led not only by Diego Pavia, who is the man, but also the success of the baseball program, who was the number one seed in the SEC tournament and one of the preeminent programs in the country. But then our basketball teams, Alex. The women have lost only, I think, 2 games this year. Like they're 21 or 22-2, and the men are 20-4. And it's been a generational run for Vanderbilt athletics over the last year, and for some programs like baseball and tennis and women's bowling. Who knew?
Decades for those teams, and Vanderbilt football, I think, peaked in the AP rankings in last year in 2025 at number 9. Yep. Incredible. I think 10-3 overall. When I was there was when Jay Cutler was the quarterback, and I think we got our first bowl game in decades by just going 8-8 as an SEC team. Like that was unheard of at the time, because Vanderbilt
we won a grand total of 6 or 7 games while I was on campus.
Yeah.
Over 4 years.
Well, because you're playing against Auburn and Ole Miss and Louisiana and Tennessee. I mean, these are huge teams, right? Like Alabama, right?
I'm still convinced Louisiana State used to put their defensive linemen on horse steroids. The defenses you'd face, the offenses you'd face. It's fun as a Commodore fan to actually see in this new NIL era, this era of greater exposure, the team compete in a world where you didn't think they could before.
Well, even I watched basketball. We had a tough loss, I think. To win last night against Auburn. I think they're ranked 19th at the moment in the NCAA, and you got the tournament coming up next month. Great squad on the men's basketball team, Tyler Tanner and others that just look good. They just look good. And I always laugh. People don't know the Vanderbilt basketball. I forget the name of the stadium, but it's got a raised court. It's like the only one in the NCAA. Literally, it's like a stage. Like the team sits, and the audience, the first row of the audience is at like eye level with the court. So
benches
that was always
on the baseline, the Memorial Gym. It's a magical place. It doubled as a concert venue and basketball stadium, which is why it has this odd architecture, but a really historic gym with a lot of personality. And Vanderbilt's football stadium, used to be mocked as something that looked like a lower tier Texas high school football stadium. They weren't necessarily wrong, but they've done a remarkable job of renovating that. And Hawkins Field, where the baseball team plays, has for years been just one of the most fun, sort of intimate venues with some personality on it. Got a big green monster. It's just a magical time for Vanderbilt, and another example of athletics helping to boost a university overall. And from an academic perspective, Alex, I don't know what your SAT was like, but I'm not sure I'd be able to get in if I were applying today.
It's definitely improved a lot. This is great. Well, Go Doors, Anchor Down, and Greg Xethalis, partner at Multicoin, General Counsel at Multicoin. Greg, thank you so much for coming on Galaxy Brains.
Thank you, and happy birthday, Alex.
Thanks, Greg. That's it for this week's episode of Galaxy Brains. Thank you to our guest, Greg Xethalis, the partner and general counsel at Multicoin Capital, and our friend Beimnet Abebe from Galaxy Trading. As always, everyone have a safe and happy weekend, and we will see you next week. Thank you for listening to Galaxy Brains, the weekly podcast from Galaxy Research. I'm Alex Thorn, head of firm-wide research at Galaxy. Follow me on X at Intangible Coins. Follow Galaxy Research on X at GLXY Research. Read our written reports at galaxy.com/research. And don't forget, if you like Galaxy Brains, to like and subscribe on your favorite podcast platforms like YouTube, Spotify, Apple Podcasts, and more. We'll see you next